Welcome, everybody. Glad to be back here with you. And today, excuse me, I did want to talk to you about protection strategies. The market has been very challenging, to say the least, the last couple of months. And I think what I'm going to show you today will help you immediately, and certainly will help you even more if we do end up getting the excuse me, the bear market that a lot of us have been waiting for quite some time. So welcome. Again, I'm Vince Vora. I'm the head trader here at Trading Wins. I have been doing this for a little over 30 years. It's been a fun ride, but it certainly never gets boring. Please do remember that trading can be risky. So please don't trade with real money until you are completely comfortable with the system that you're using. I see some familiar names. Hey, Michael, how are you? Good to have you back with us again. Okay, in today's presentation, I'm going to talk a bit about bear markets. We'll go into a bit of the history of it. We'll talk about whether or not, a bear market is imminent here in 2018. There's a lot to look at. We'll go over a couple of different protection strategies that you can use right now. I'll show you a few other tools that you can use, not just in bear markets, but anytime, to help you with your trading. And hopefully, if we have any time at the end of this, we'll try to answer as many of your questions as possible. So let's talk about bear markets. You'll hear pros say many times that markets don't die of old age. And that's because bull markets can continue to run for a very long time. Look at the one we've been in now. We're almost, getting into the 9th year now of a bull market. So it's been going on for quite some time. The average bull market is about 5 years, but this one has really gone on for quite some time. So it is a good time, I believe, to start looking for signs of a market top. Now, since the 30s, we've had about 12 bull markets, and obviously they've all been followed by bear markets or downturns of approximately 20% or more. Now, the average bear market decline has been about 40%. The dot-com bear market in 99-2000 was a little more than that, was about 50%. And the mortgage crisis bear market of 08-09 was actually 57%. Where are we going from here? And how significant of a bear market can we have when it does hit us? Because it's inevitable. I think it will at some point. But I personally believe that the next bear market can make these drops appear to be just like small pullbacks. Unfortunately, I think it's going to be an epic one. Let's talk a bit about the signs of a bear market. And I'm not trying to scare anyone, all right? Please, let's be clear about that. I'm not trying to say it's happening right now, even though it could be. We'll go into the technicals, but I'm not here to scare you. I'm here to show you how you can easily protect your position. So even if we do get a bear market, regardless of the size of a pullback, it doesn't have to hurt you. Okay, so one sign of a bear market is extreme optimism. So the more bullish or confident the investing public gets, the riskier it becomes overall. I mean, and that's just a fact. We've seen this happen over and over again, and we've seen some recently. Look at some of the headlines we've seen recently in Barron's. There was a cover story titled "Next Step Dow 30,000." A very, very bullish sign of extreme optimism. If we look at the fear gauge, the VIX, which is the CBOE, Market Volatility Index, it's been near all-time lows for years, many years now. Recently, it's popped up a little, and that's why I say, are we already seeing the start of this bear market? We'll show you a few more signs as we go through. Consumer confidence numbers. In February, we saw the highest reading in 15 years. Also something we need to sit up and take note of. Higher borrowing costs. That's a sign of a bear market. And we've already started to see that. The Federal Reserve has already started to hike short-term rates. They expect at least another 3 more this year and 2 next year. And so we could see a continuation of that pattern. Higher rates hurt the economy. They actually slow it down, and usually result in lower stock prices. Higher rates also make it harder for individuals, borrowers, to keep up with their debt. Paying off credit card debt, mortgages, etc. With higher rates, the higher the rates, the more interest people pay for their mortgage, the longer it takes them to pay it off. All of that, it just slows down consumer spending overall, and so it's something we need to pay attention to. An increased risk of a recession is a sign of a bear market. Now, the one thing to keep in mind here is that the stock market is a forward-looking indicator. In other words, you're going to see stocks drop way before we're actually in a recession, or can quantify it and say, yes, we're actually in a recession. So you'll see a slowdown happen before that. And a good sign of it is a slowdown in manufacturing or the services sector. Now, this is where all the talk recently of a potential trade war, right? What's happening now between US and China. These are the two sectors that are really going to get impacted if we end up in a full-fledged trade war. At this point, there's a lot of rhetoric. It seems like a public negotiation between the two countries. But if this carries on, you will see a significant impact to manufacturing and services, which will be, which could easily push us into a recession. Okay, and why are recessions bad? Well, jobs get lost, right? If products become more expensive, fewer people buy them, there's less of a need for them, people start losing jobs. That's what it comes down to. As the consumers stop spending, that's when everything falls apart, and that's when corporations report lower profits, right? So think of it, higher rates makes everything more expensive, from credit card debt to mortgages to just about anything. You get a trade war going, you have your everyday products, from food to anything else that you buy, be more expensive. People are going to spend less. Naturally, they lose their jobs, they'll spend even less. So it sort of feeds on itself, and it can really get out of hand. We've seen it many times. Weakness in leading stocks is a sign of a bear market. In other words, the stocks that got us to the height where we're at with the markets are the ones that will usually roll over and lead us back down. Why? Because since we've gone up so fast and so hard, and I'm really referring to the tech sector right now, and I'll show you this on a chart when we get to it, there's no support. You look at stocks like NVIDIA, like Facebook, all of those that really went on a real tear over the last couple of years. You look below, there's very, very little support. So when they do top out and roll over, they tend to fall pretty quickly and lead the market lower. Okay, and when this happens, that obviously means that people have stopped buying, right? Which is a sign that they're losing confidence in the market, and that's your turning point. So again, Facebook, Google, Apple, NVIDIA, Boeing, you name it, some of the bigger names that have led us higher through the bull market have already started to roll over. Market breadth is another sign of a bear market, or it could be, and this is a technique that we use to gauge the direction of the market by looking at the number of companies advancing compared to declining. In other words, one of the best and most reliable indicators out there is the number of 52-week lows compared to the number of 52-week highs. Right now, since the middle of March, we've really seen a turn. Before the middle of March, we had way more 52-week highs than we did see 52-week lows on a daily basis. Since the middle of March, that has really shifted. Now, this week, we've had a few days that were considerable up days in the market, right? And yet, the numbers have not improved. If you look at this past Monday, April 2nd, we had 133 52-week lows and only 16 52-week highs. So the trend continues. April 3rd, 89 new lows, only 14 highs. On Wednesday the 4th, 84 new lows and 26 highs. So regardless of up days, and even yesterday, I believe it was like 8 new highs and 21 new lows or something like that, even though we had another nice bounce in the market. Today we're dropping overall, and it'll be interesting to see these numbers at the end of the day, how they look. But again, since the middle of March, and we're already into the first week of April, we've consistently seen way more in new 52-week lows than we have new 52-week highs. So not a positive sign. Now, let's go to the charts here and look at the technical picture overall. This is a tactical trader platform, and this has some unique tools that I'll share with you in a moment. But for now, I want you to just focus in on the chart. This is a chart of the SPYs, a daily chart of the SPY. So again, we had been in a very, very strong bull market for a very long time until early February. The beginning of February felt like the bottom fell out, and we just collapsed. We tried to recover a couple of times here and then failed again. And now we're at that point where things are very interesting. We could in a little while potentially call this a double bottom. Right now, what do we need to see to confirm that this is a double bottom? Well, we would need to see a move above the highest point between these two lows, which is back up in here, above 280 on the SPYs. We're far from there right now. Now, we saw a nice bullish reversal pattern here a couple of days ago, right in here on the 4th. Where we had this bullish engulfing pattern. And we followed through the next day, although it wasn't much of a follow through, and today we're failing again. So today's close is going to be very, very important, okay? But overall, the easiest way to judge where we're going next in the markets is to draw a line at the absolute low here that we've had recently, which is right in here, the Feb 9th low, right near 253, and the most recent highs, which are right up in here, the Jan 26th high. Okay? Unless and until we break either above those highs or below these lows here. Let me get rid of this line so we don't confuse ourselves. There we go. That's when we're really going to know in which direction this is going to go. So this Feb 9th low is absolutely crucial. Absolutely crucial. If the market doesn't hold it, we may have seen a top here on Jan 26th for quite some time. So, good reversal here, not a strong follow through. We're failing today. Love to see a recovery by the end of the day and move back up. But if we start to sell off, and especially if we trip the Feb 9th low, I think look out below is what we'll be talking about for the next several months. So how do we protect ourselves? That's the main question. What can you do here to protect yourself in case we will or are about to see a much more significant drop? And what I'm about to show you, you can use all the time, even throughout a bull market. It's always a good idea to protect yourself. You never know, what could be announced, whether it's a major news story, some unexpected event, or just some negative news on whatever stock you're holding that causes a gap against you, that sort of thing. So it's always good to have protection. But in this environment, where things are clearly a lot more volatile than what we've seen throughout this bull market, I mean, just look at the range of the bars here, how much wider they are from high to low compared to the bars throughout that constant run higher. Okay, that's a clear sign of extreme volatility. And so how do you protect yourself? Well, one of the things you can do is to tighten your stops. First of all, you should always work with stops, okay? But you need to tighten them up a little. one of the things you can use here is an indicator here known as the super trend. I'm going to throw this on, and I'm actually going to go into the settings, because if you do use the super trend or plan to use the super trend indicator, I want you to tighten it up a little. I would personally use 10 and 2 rather than the default 10 and 3 settings. You can go even closer and tighten it up to 10 and 1. When I do this, you can see here, you can see that line, how it follows the stock. Let me widen it out again. There's 2, there's 3. So for me, 3 is a little too wide. You know, it gives it a little too much of room to pull back. I think 2 is a real nice balance. But again, if you really want to be conservative, drop it to 1, and you'll see how tightly it follows it. If you don't have access to the super trend indicator, you can use something like the parabolic SAR. And if you do, make sure you use the setting of 0.02 and 0.2 on the parabolic SAR. Again, it's 0.02 and 0.2. It'll do something similar here, but the super trend indicator is really helpful, not only to help you stay in that trade throughout a sustained trend like we see here, but to help you get out as soon as things start going against you. Okay, so something this easy to use can really be effective and save you from a lot of pain. Okay, because if you're just trying to judge it yourself looking at the candles, you know, every time we look at a chart, we see something different. And we're always looking to justify why we should stay in there because greed kind of takes over and we want more and more profit, right? But before you know it, you know, going on hope, it really can go against you quickly. Remember, bear markets happen a lot faster and are a lot shorter than bull markets. Okay, they tend to be, again, very volatile, very sharp. When panic sets in, things fall apart very quickly, as compared to when things are going up. It's usually just a slow, boring kind of you know, grind higher, which is beautiful, which as a trader you should love, but you need to absolutely protect yourself here. Now, another way to protect yourself is to find some tools that can give you an edge in the market. So there are plenty of other protection strategies, and I'm going to touch on those later on in the presentation. But before we get there, there are some tools you can use that can really sort of stack the odds in your favor. One of them, which I've started using a lot more recently, is seasonality, because seasonality will give you trends over that, you know, that statistically have proven to happen over many years, and a lot of times that individual stock that has that seasonality trend will go against whatever the market is doing for whatever reason. You know, there's a particular month or a particular week where that stock makes a run every year, and trading those will put the, you know, the odds in your favor. Question is, how do you find them? Well, on the Tactical Trader platform, they do have a tool here where we could look for seasonality trends. Okay. Now there's a simple view and there is an advanced view. Here, the advanced view gives you a lot more data. If any of you love to dissect data, you're going to love that. I'm going to stick to the simple view here. And looking at the SPYs here, and let's go back as far as 1990, okay? And you can see here that there are certain months that stand out, okay? And what you're looking at here, for example, these percentages at the top of the bars. For example, the month of April, we see that 77% of the time from 1990 to present, okay? So we're talking, you know, what, almost 28 years or so. We're talking 77% of the time we've seen a gain in the month of April, of an average of 1.8%. Now, that may not sound like a lot, but it's certainly more bullish than it is bearish, right? That happens again here in November. But what we can do here is go to the right of the chart here on this column. And at the bottom here, there's a scanner, a seasonality scanner. If we click that, now we can run a scan for seasonality. We can choose which market. I'm going to leave the NASDAQ 100, but you can see here that there's S&P 500, the Russell, the Dow, there's Forex, there's cryptocurrencies, futures-based ETFs, currencies, you name it, all ETFs. You can choose all U.S. stocks. I'm going to stick with the NASDAQ 100 for now. You can define the minimum growth you're looking for. So I want at least an 80% chance that we're going to see an increase during that particular month. I also want to see a minimum of 2%. But again, you can change this yourself. You can set your own parameters. And I'm going to do a search for the month of April for now. And I'm going to go back as far as 1990. So I'm going to run that scan. And as soon as you click it, you can see how quickly, first of all, it runs the scan, but how great this information is. First of all, you can sort it if there's a long list by clicking on the titles here. And you can see that PayPal says 100% average gain of 4.89%. Let's click on it. And we're going to bring up that chart here. And there it is. During the month of April, 100% of the time since 2015. This is a newer issue. So that's not really going back too far, right? And statistically speaking, that's not very significant. Looking back, only 3 years. But for whatever reason, over the past 3 years, during the months of April, July, and October, 100% of the time, we've seen a significant increase. So, you want to mark those months in your trading journal. And then the month before, as we're heading into that month, you want to keep that symbol on your watch list and you want to look for a setup with whatever strategy you're using heading into that month. Okay, you don't want to just blindly on April 1st, for example, buy and then plan to sell on April 30th. That's not the way it's going to work out well for you. You want to look for a proper setup heading into that month. But it is great information to know well ahead of time so you can plan for it, okay? Let's look for something a little more significant. Let's look at MELI. Now this one goes back to 2007, okay? So we have, statistically, we have a lot more time here. But again, in April, for whatever reason, 82% of the time during the month of April since 2007, we've seen an average increase of 11.3%. So that's something you definitely want to note. Okay. How about this? Now here, we're going back to 2008. Let's see MDLZ here, 2001. Okay. So, we're going back, 17 years? That's significant. 88% of the time in April, up on average of 3.9%. That's what stacks the odds in your favor, okay? And when you can go way back, so that you can look even including other bear markets. See, through here, we went through the 2008 crash, yet, these are the numbers. So that's pretty impressive. We can also quickly look through May. What's happening in May? What's coming up in May here? Let's see what happens. Here we go. There's a KHC. Let's see how far back that goes. Well, that's also 2015, but we see a couple of months with 100%. What about TMUS? That's 2013 as well. Dollar Tree. There we go. Dollar Tree, 1995. So statistically, this is extremely significant. 83% of the time during the month of May, we see an average of 5.9%. Okay. So again, by doing this, by using a strategy you can rely on, you can stack the odds in your favor. And you already know going into this trade that you have a very, very high probability of success, okay, regardless of what the overall market is doing. And then if you add in all the protection strategies that I'm going to talk about here, it just makes trading so much safer and improve your odds of success so much with these tools. Another tool they have here is an earnings tool. I don't know how many of you might be a little more aggressive and might enjoy trading around earnings season. What the earnings tool will tell you is, again, statistically speaking, going way back here, and you can select which quarter you want to look at, okay? It will tell you how that stock performed 1 day after earnings, 3 days after earnings, 5 days after earnings, and 7 days after earnings. So again, I don't know. Let's see. And there's a scanner for this as well, which I want to show you. Okay, but let's just pick any stock here. Let's go back to earnings here. Let me default it. There we go. So NVIDIA, for example, Q2 data since 2013. Okay, 1 day after, up on average of 0.38%. 3 days after, 7.5%. 5 days after, 10%. Right, 7 days after, almost 10% still. So you get a clear picture over a number of years of how this performs after earnings on that particular quarter. Let's look at Q1, for example. There, it still does extremely well. 4%, 6%. Let's see what Q3 brings, right? Look at Q3, 1 day, 3 days, 5%. Yeah, so far Q2 looks to be better. And we're heading into Q2. So Q4 as well, 5%, 6%. There you go. It's just great information to have, right? Anything. You want to look at Apple? Let's look at Apple. See how Apple does after earnings. And again, you can go back. You can choose the data and go back. Let's look at McDonald's since 2012, Q4. Let's look at Q2 for McDonald's. There we go. 3 days, 5 days, 7 days. All really, really helpful tools. Okay. And the platform has scanners for other strategies that you can use, Fibonacci tool that you can use. There's alerts you can set, you name it, and it's a very robust charting platform as well. But if you mix this with protection strategies like that super trend indicator to get you out in case things go wrong for you, then you're really stacking the odds in your favor. Okay. I also want to show you here that if you go to tradingwins.com/spring, okay, we've put together a couple of packages for you that I think are really going to help you right now in case we're on the cusp of that bear market, which I think we are. Again, it's not going to be confirmed unless and until we break below those Feb 9th lows, but we're close. We're almost there. So if you go to tradingwins.com/spring, what we've done is we've put together some training for you. And during this training, we're going to cover 4 additional protection strategies that you can use. We're going to talk about hedging your positions using products like the VIX or VXX, okay, that CBOE market volatility index. We're going to show you how to hedge your portfolio using those. We'll show you how to use an effective way to use married puts. Now, I love using married puts all the time, even throughout bull markets, and there's various ways to do it. We're going to show you an effective way to protect yourself now. With the premium package, you will also we're going to talk about using how to diversify. We're going to talk about global diversification. We're going to talk about dividend paying stocks, how to use those effectively. We're going to talk about collar trades. And also, I'm going to give you a list of ETFs that really perform well throughout a market downturn, okay? So those alone will give your portfolio a huge boost. But you're also going to get 30 days of mentorship with myself with our pro membership service. That includes nightly videos. Also, as a member, you will join us twice a week for live market chats. You get to come into our room, ask me any trading related question you like. And we also, every month for our pro members, have a course of the month. Another one is coming up next week, I believe. You'll get notice of that and be invited to that at no extra charge whatsoever. And we are offering a 30-day no question asked money back guarantee, even though this is only $7. We really want you to see what we do here at Trading Wins. This is not a moneymaker for us, and trust me, you're getting a lot more value than just $7 here. Now, if you prefer the double feature, the package on the right will get you everything that I just explained in the package on the left, along with a 30-day membership to the Tactical Trader platform, which I just showed you, that comes with the full suite of products, those tools, the seasonality tool, the earnings tool, all of that you get. You'll be able to play earnings like a pro. The seasonality, I think, is invaluable. This, honestly, bear market, bull market, you name it, you fill your journal with those dates and only trade those stocks that give you a real high percentage chance of success. And again, it's not just stocks, Forex, futures, ETFs, you name it. And again, there's a 30-day no questions asked money back guarantee here. The double feature is just $14. So tradingwins.com/spring. That'll get you to this page. Just click on the green button for whatever package you like, and you get all of that included. Okay, as soon as your order is processed, you will get the on-demand recording, and then you get the info for our membership. That you'll start receiving those invites to the live market chats, start receiving the nightly videos, the invite for the course of the month, you name it.